140 years old, 62 consecutive years of dividend increases. And this week, they just told Wall Street to expect $100 billion in revenue this year. Not someday. This year.
Johnson & Johnson, the original healthcare conglomerate that reinvented itself, and did it quietly, methodically, the way only a 140-year-old institution can.
I'm Hudson Thomas. Welcome to Charged Alpha, the S&P 500 stock encyclopedia. Today we're going deep on JNJ, Johnson & Johnson, fresh off Q1 2026 earnings reported April 14th. And there is a lot to unpack here.
They beat on revenue, beat on earnings, and raised full-year guidance, clean beat and raise. And yet the stock pulled back slightly in the days following. The market giveth and immediately complicateth.
The eternal pattern. All right, Lana, let's walk it from the ground up. So let's orient people. Johnson & Johnson was founded in 1886 in New Brunswick, New Jersey. Not a typo, 1886. By three brothers, Robert Wood Johnson I, James Wood Johnson, and Edward Mead Johnson. They started making surgical dressings at a time when antiseptics were still a novel concept.
140 years later, the company they built now employs 138,100 people and operates across 160 countries. What changed most recently is what they stopped doing.
The Kenvue spinoff.
Exactly. In 2023, Johnson & Johnson spun out its entire consumer health division, Band-Aid, Tylenol, Listerine, Neutrogena, into a separate publicly traded company called Kenvue. The logic was straightforward. Those consumer brands generate steady revenue but low growth. Pharma and medtech generate higher margins and faster innovation cycles.
So the J&J you're investing in today is not the J&J your grandparents knew. This is a pure-play healthcare innovation company.
Two segments. Innovative medicine, which they used to call pharmaceuticals, covers prescription therapies across oncology, immunology, neuroscience, pulmonary hypertension, and cardiovascular disease. That's roughly 64% of revenue. MedTech covers surgical cyst electrophysiology, orthopedics, vision care under the AcuView contact lens brand, and the newly acquired Shockwave Medical cardiovascular platform.
What's the moat here? Because pharma sounds like a constant patent expiration treadmill.
The moat is layered. You have an 80,000-person commercial organization, the relationships with oncologists, rheumatologists, cardiologists that took decades to build. You have manufacturing scale for complex biologics that competitors struggle to replicate. You have a $16 billion annual R&D budget, sustaining one of the deepest pipelines in the industry. And AcuView holds over 50% global market share in premium daily contact lenses, a truly sticky consumer technology in a medical wrapper.
And Darzalex is the headline drug right now.
Darzalex is the story, multiple myeloma treatment. It crossed $4 billion in quarterly revenue for the first time in Q1 2026. To put that in context, that is a $16 billion annual run rate from a single drug, and it is still growing at over 20% year over year.
Let's talk about who's driving this. Joaquin Duato has been CEO since January 2022, 4 years in, and became chairman in November of that same year.
He's a lifer. Born in Spain, earned his MBA at ESAD in Barcelona, added a Master of International Management from Thunderbird in Arizona. He joined Johnson & Johnson through Janssen Pharmaceuticals in Spain in 1989. So that's over 35 years with the company before he took the top job.
The guy has been in the building literally his entire professional career. He speaks English, Spanish, and Italian, which for a 160-country operation is more than a resume line.
He served as vice chairman before stepping into the CEO seat. And the defining move of his tenure so far has been the portfolio transformation. The Kenvue separation, which monetized $50+ billion of consumer health value, followed by redeploying that capital into two large acquisitions, $13.1 billion for Shockwave Medical and $14.6 billion for intracellular therapies, which brought the Caplyta psychiatric drug into the portfolio.
Aggressive M&A strategy, buying into higher growth areas.
And he has credibility on execution. Q1 2026 was a clean delivery. Revenue beat, earnings beat, full-year guidance raised. Analysts who upgraded, Morgan Stanley went overweight in January, appear to be getting validation.
All right, the numbers, Lana, walk us through it.
Starting with Q1 2026. Revenue came in at $24.1 billion, up 9.9% year-over-year versus Q1 2025's $21.9 billion. The consensus estimate was $23.6 billion. That's a $447 million revenue new beat, or roughly 1.9% above expectations.
That's a real beat, not a rounding error beat.
On earnings, adjusted diluted EPS was $2.70 versus the $2.68 estimate, a Lu2 beat. GAAP EPS was $2.4. The difference primarily reflects amortization of acquired intangibles from the Shockwave and intracellular acquisitions.
So the gap in adjusted split is structural, not a one-time surprise.
Correct. The adjusted figure is the more operationally relevant frame given the acquisition activity. On valuation, this is where J&J's story gets interesting. At a stock price of roughly $235, the forward price-to-earnings multiple on full-year 2026 adjusted EPS guidance is about 20.3 times. The trailing 12-month PE is 27.3, and price-to-sales on a trailing basis is 5.87 times. Price-to-book is 7.04 times.
Those are premium multiples, but for J&J, are they really premium?
That is the core question. The 5-year average PE for J&J is closer to 25 to 30 times, so a 20x forward multiple is actually toward the lower end of its historical range. The market is pricing in some uncertainty, primarily around the Stelara biosimilar headwind, but arguably not pricing in the full Darzalex growth trajectory.
On margins, what do the numbers look like inside the P&L?
Gross margin for Q1 2026 was 71.5%. That's the take rate after manufacturing cost. Operating margin was 26.6%, and trailing 12-month net margin is 21.8%. These are genuinely high-quality margins for a company at this revenue scale.
And the cash flow story?
This is the core of the investment thesis. Trailing 12-month operating cash flow is approximately $24.5 billion. Free cash flow after capital expenditures is approximately $19.7 billion on a trailing basis. That is prodigious free cash generation, and it underwrites everything else.
The dividend, the buybacks, the M&A capacity.
All of it. The annual dividend is 520 cents per share, a 2.2% yield at current prices. And this is the 62nd consecutive year of dividend increases. 62 years. That is not a streak you break accidentally.
The balance sheet?
Cash on hand of $19.7 billion. Total debt of $47.9 billion, with net debt of $28.2 billion. Current ratio of 1.03, tight but manageable. The interest coverage ratio is comfortably over 30 times. The debt load is not a stress point at this earnings level. Total assets are $199 billion. Overall, Johnson & Johnson's financial health is strong, with 71.5% gross margins, approximately $20 billion in trailing free cash flow, a 62 consecutive year dividend growth streak, and raised full-year 2026 guidance following a clean Q1 beat.
What does Wall Street think of all this?
The consensus rating is buy. 19 analysts tracked in our data, 11 buy ratings, 8 holds, 0 sells. The average price target is around $255, which implies about 8.6% upside from current levels. High target is $283 from Morgan Stanley. Low target is $235 from some of the more cautious names.
Morgan Stanley is the most aggressive bull here.
They raised their target to $283 post-earnings and maintained overweight. That call follows their January 2026 upgrade from equal weight. They had been neutral on J&J for most of 2025 and pivoted bullish when the portfolio transformation started showing results. Wells Fargo also raised its target to $263 from $240s on the back of Q1 results, maintaining overweight. Barclays maintained equal weight with a $255 target.
The pattern is consistent. Most of the upgrades happened before earnings, and the post-earnings activity is mostly price target adjustments upward rather than rating changes.
Q4 2025 set the table. J&J reported $24.6 billion in revenue and adjusted EPS of 246 cents, matching the estimate. And Q3 2025 was a beat, $2.80 adjusted versus the $2.76 estimate. So the company has built a pattern of clean executions that's winning back analyst confidence.
The guided Q2 2026 adjusted EPS is approximately $2.87 based on consensus. That would be another solid step forward. Let's run the tape from both sides. Lana, you take the bear case, I'll carry the bull.
Always the skeptic.
The bull case starts with Darzalex. A single drug at a $16 billion annual revenue run rate and still growing at 22%. You layer Tremfya surpassing $5 billion in annual sales, Icotide generating over 1,500 prescriptions in its first few weeks post-launch, Caplyta now in the portfolio for the expanding mental health market. This is a company that keeps finding the next billion-dollar asset.
And MedTech.
Shockwave Medical is on track to become J&J's $13th billion platform by year-end. The polyphonic digital operating room ecosystem is in beta across 10 U.S. hospitals. J&J is digitizing surgical medicine, and that is a first-mover position with high switching costs once hospitals are on the platform. Add 62 years of dividend growth and $20 billion in annual free cash flow. This is quality on sale.
I'll take the other side. The Stelara headwind is real and large. That drug generated roughly $10 billion in peak annual revenue, and biosimilar competition is now compressing innovative medicine segment growth by approximately 9 percentage points. That is not a rounding error. That is a cliff that requires the rest of the portfolio to outrun.
Darzalex's $16 billion run rate is bigger than Stelara ever was.
Today. But the talc litigation is the unresolved tail risk that the market has been uncomfortable pricing. 3 attempts to use the Texas two-step bankruptcy strategy to ring-fence the claims have failed or been contested. The litigation overhang is real, the liability is uncertain, and a material adverse ruling in pending appeals could force a significant reserve increase and draw cash away from capital allocation priorities.
That is a real risk, and so is the patent cliff. Tremfya, Rybrevant, Darzalex itself eventually. The $16 billion annual R&D budget is J&J's answer to that, but that is a high-stakes runway maintenance operation that never stops.
The bear is not betting J&J fails, the bear is betting the multiple already reflects the good news and that the headwinds are underestimated. At 20x forward earnings with 0 sell ratings, the market has consensus optimism baked in.
Both views have merit. Clean up the talc situation and execute on Darzalex continuity, and the bull case looks very strong. How does J&J compare to the rest of large-cap pharma?
3 names for context. AbbVie, ticker ABBV, is the most relevant structural comp. They faced their own patent cliff when Humira went off patent, and they navigated it with Skyrizi and Rinvoq. AbbVie is growing revenue at roughly 12% and trades at about 6.7 times price to sales. The market rewards them for proving you can replace a blockbuster with another blockbuster.
But J&J is at 5.87 times price to sales, so it's actually trading at a lower multiple than AbbVie despite having a much larger and more diversified revenue base.
That discount reflects 2 things, the talc litigation uncertainty and the fact that J&J's medtech segment gets a lower organic multiple than pure pharma. Pfizer is the opposite end of the spectrum, trading around 2.5 times price to sales. Revenue is declining roughly 5% as post-COVID Paxlovid volumes normalize. They're cheap for a reason.
And Merck?
Merck is at roughly 4.6 times price to sales, with around 5% revenue growth driven almost entirely by Keytruda. The risk there is Keytruda's patent cliff approaching 2028 to 2030, a similar structural question to what J&J faced with Stelara, but more concentrated.
The peer picture says J&J is not cheap, but it's not expensive relative to a diversified healthcare franchise of this quality and scale. Let's check in with the options market.
The put-call ratio is running around 0.77. That's modestly bullish, with more call activity than put activity. Implied volatility is at roughly the 38th percentile, below the historical midpoint, consistent with J&J's beta of 0.33. This is one of the least volatile large-cap stocks in the index.
Options traders are not pricing in fear here.
No. Call open interest is concentrated at the $250 and $260 strikes, which maps closely to the Wells Fargo and Morgan Stanley price targets. Put protection is stacked at $225 and $220, suggesting institutional investors are hedging against a pullback toward the 200-day moving average level, but not positioned for anything catastrophic.
Measured sentiment. Appropriate for a company that just beat and raised. What are insiders doing?
Net selling in early 2026. 2 executive VP-level transactions in February. Vanessa Broadhurst sold approximately 6,200 shares at around $243, and Timothy Schmid sold roughly 22,600 shares at similar prices. total around $7 million across both transactions.
That sounds like a lot, but in context,
For a stock at $235 and executives with potentially tens of millions in stock-based compensation, $7 million in February selling is consistent with routine tax planning and diversification, not a directional view on the stock. There are no C-suite departures, no abnormally large concentrated sales, and no buy-side insider purchases either. It's neutral.
institutionally,
Morgan Stanley and Goldman Sachs both hold significant positions and have maintained or upgraded their ratings. No signals of institutional distribution visible in the institutional holder data.
let's crystallize the key risks and forward indicators before we wrap.
The talc litigation is the top watch item. The third Texas two-step attempt to use subsidiary bankruptcy to ring-fence the claims has faced judicial headwinds. Any adverse ruling, particularly from an appellate court, could force Johnson & Johnson to materially increase its reserve, drawing cash away from dividends, buybacks, and M&A.
The second is the Stelara replacement math. 9 percentage points of headwind on pharma revenue means J&J needs Darzalex growth, plus Icotide, plus Caplyta, plus Rybrevant to fill a large hole. Q1 2026 showed it's working, but the margin of error narrows if any one of those assets underperforms.
Third is the patent cliff framework. Darzalex's core patents are currently protected, but the company needs constant pipeline replenishment. The $16 billion annual R&D budget is the answer, but investors should watch the Phase 3 pipeline for failures or delays in key programs.
And fourth is tariff and pricing policy risk. Pharmaceutical import tariffs, if enacted, could affect J&J's non-U.S. manufacturing cost base and margin trajectory in ways not fully priced into current guidance. All right, the bottom line. Johnson & Johnson is a 140-year-old healthcare institution that just delivered its cleanest quarter in recent memory. Beat on revenue, beat on earnings, raised the full-year outlook, and reconfirmed a 62-year dividend growth streak that is almost absurdly rare among public companies.
The strategic simplification, spinning out consumer health through Kenvue and redeploying capital into higher growth pharma and medtech, is showing up in the numbers. Darzalex at $16 billion annualized, Tremfya breaking $5 billion, Shockwave approaching the billion-dollar milestone. This is a company that knows how to find the next generation of assets.
The risks are real. Talc litigation is unresolved and unpredictable. Stelara is declining faster than some hoped. Patents expire. But at 20x forward earnings with $20 billion in annual free cash flow and 62 consecutive years of dividend growth, you are getting institutional quality healthcare at a reasonable price.
The key metric to watch is innovative medicine organic growth excluding the Stelara headwind. If Darzalex, Icotide, and Caplyta can sustain double-digit growth in the underlying portfolio, the full-year guidance is beatable. If any of those stumble, the math gets harder.
I want to close today with a quote that feels made for a company built around patient outcomes.
Go ahead.
Sir William Osler, one of the founding fathers of modern medicine. The good physician treats the disease. The great physician treats the patient who has the disease.
For a company whose credo puts patients first, literally, and whose CEO talks about healthcare transformation in the context of individual lives rather than just revenue lines, that's the right frame.
Johnson & Johnson is betting that being the great physician, the one who sees the whole patient, not just the molecule, is the durable advantage in the AI era of medicine. The polyphonic operating room ecosystem, the AI drug discovery acceleration, the global scale of clinical data, that is the thesis. That's going to do it for today's episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.